Grindrod posted a 32% decline in earnings to 530.9 million rand for the year ended December 2011, and the numbers impacted by weak shipping markets specifically. Headline earnings per share decreased by 41% to 99.6 cents per share. And joining us in studio for more on the results is the company's CEO, Olivier. Thanks so much, Alan, for joining us today. Well, the business still feeling the pressure of, as I said, the weak shipping markets. We've had headline earnings per share down 41%. What's your outlook for the shipping market right now, and where do you see prices heading? Give us a sense of the environment that you're operating in.
Certainly shipping is very uncertain at the moment, unlike our other businesses, but within the shipping market we've seen the Baltic Freight Index year on year as an average fall by 44% from 2010 to 2011. We've seen a bit of further decline in the early part of this year, which has dragged pricing down a little bit with that. But you've got to look at these markets slightly differently. You've got this dry cargo market, which what I was just talking about, but you've also got a tanker market on the other side. The tanker market has been the business that has lost Grindrod money over the last 2 years. The dry cargo business has been in profit, both last year and again this year, making a substantial profit. The results themselves this year, although they were an overall loss, there was a one-off write-off there where we cancelled a couple of ships being built in China at the end of the year. It had a one-off cost of about 50 million rand on the income statement. So there was a material impact in there. But going forward, I think we've seen the tanker market, which, as I said, has been the key negative in terms of earnings. We've seen that bouncing along the bottom. We're seeing a little bit more opportunity or a little bit more optimism in that market, a slight tick up in rates, and also an order book which is pretty balanced now. It's coming to the end of the supply side. So there's some light at the end of the tunnel there. On the dry cargo side, though, we're still under pressure with new buildings delivering into the market, particularly at the big end of the market, the Capes and the Panamaxes. Whereas at the smaller end, where our major exposure is on the handy sizes, again, we're moving slightly towards a more balanced market in terms of supply and demand. There's a lot of scrapping going on in that market. There's limited bank financing in that market as well, which means the pressure's on. And it's pushing prices down a little bit, but also it means it's going to shorten the market in terms of recovery of this market. It's going to shorten that period, because you're not going to see more orders placed. You're not going to see a huge amount of activity, and I think we'll get back to a balance sooner than we may otherwise have.
So how's that influencing or impacting your rolling off hedges? Because you saw that coming through, where you were exposed more to those rates. Now, is that a position that you're maintaining?
Well,
where do you stand?
In a weak market, which is what we're in, you don't want to take too much contractual cover. So we're not taking a lot of contractual cover at the moment. And obviously the cover that we've had in previous years is starting to come to an end. Critically, though, our tankers are largely uncovered. We don't have a lot of cover in that market, and that's the market that has been going has been bouncing along the bottom for some time. On the dry cargo side, as I said, the biggest exposure is on the big ships, the Capes and the Panamaxes, and that is the area where we've got our most cover. Where our Capes at the moment are largely covered out, our Panamaxes are 100% covered out, and that cover still goes for a number of years.
Okay, so let's focus on another part of your strategy to cushion through the tough times here, because 2011 was a big year in terms of re-strategizing for Grindrod as a group, advancing in the ports, terminals and rail infrastructure space in Africa. Is that your target now, becoming this integrated freight and logistics service provider?
I think it's very important. You've seen the earnings in all of our businesses, bar shipping, have improved this year, some of them quite substantially. We went out to the market during the year, went to our shareholders and got approval to raise 2 billion rands worth of capital for the opportunities that we were seeing. So we've had endorsement for the strategy from our shareholders. In addition to that, we brought in a new partner in Vitol, the world's largest independent oil trader, who are very focused on building a coal business at the moment, and we formed a joint venture in coal with them. And that obviously is going to assist us in rolling out part of our strategy, which is the development of Maputo Port, and also we've aligned our coal trading business with their Southern African coal trading business and set up a substantial coal trading business in Southern Africa as well. So we're rolling out that strategy, and it's looking, the opportunities are looking quite good.
When it comes to targets, I mean, what are you targeting in terms of the kind of earnings mix moving forward, where you're looking at shipping versus logistics? We know that shipping is still bulk of your business, but is there a specific target you've got inside?
I think it's very hard to target an earnings mix. As I said, the shipping is uncertain. So it's hard, but we've got a substantial amount of our equity invested in shipping, and therefore shipping should produce. And I would think with shipping coming back in time, but with substantial additional expenditure going into the particularly infrastructure part of the business, we're going forward, we're going to see a larger portion of our earnings coming from non-shipping, even with recovery in shipping. I would expect to see a larger portion.
With that CapEx spend moving further, I mean, you've brought gearing down to what, 10% from 35%. You're comfortable taking that back up again?
Yeah, we have to. I mean, we've got, as somebody said in the presentation I gave earlier this morning, is what are you going to do with this balance sheet now? Because we've only got committed about 800 million rands worth of CapEx. These infrastructure projects are expensive projects, and they're going to require significant investment. None of them are committed yet. We're still working through them, but some of them we're quite far up the road. So we're going to start investing in them fairly soon.
Well, certainly progress we'll be keeping an eye on. Thanks so much, Alan, for your time this afternoon. Of course, Alan Olivier is CEO of Grindrod.